Hello, everyone, and welcome to Factor Exposure, the foundation of smart beta, the first in our week-long series of webinars dedicated to helping you understand how and if you should use smart beta strategies in your portfolio. My name is Matt Hogan, and I'm the president of ETF.com and your host for today's webinar. I'm pleased to be joined today by two true thought leaders in the investment space, Douglas Grimm and Brian Wimmer. Both are CFAs and both are senior investment strategists for the Vanguard Investment Strategy Group. We've invited them here today to provide a foundational look at smart beta and factor exposure, and I can't wait for their presentation. Before we get started, there are a few housekeeping items that I would like to cover. First, coincident with the launch of this webinar week, we've put together a new foundational research on ETF.com to help guide you in your investigations into smart beta. We call it the Smart Beta channel, and it's available at www.etf.com/smartbeta. Go there and you'll find a guide to the smart beta space, recent articles, foundational research, and a customized data tool that helps you search for, screen, and research smart beta ETFs. Second, for today's webinar, I'd like to ask for your help in making this webinar a success. Following Brian and Doug's presentation, we'll reserve the last 15 minutes or so of the webinar for you to ask questions of our esteemed panelists. You'll find the Q&A widget at the bottom of your console. Just click on that widget and submit your questions. We'll collate them throughout the presentation and answer as many as we can at the end during the time allotted. If we don't get to your questions, we'll have them on email and can follow up from there. Third, to enhance your viewing experience, you can expand your slide area by clicking on the Maximize icon on the top right of your slide, or by dragging the bottom right corner of your screen. That will help you make the slides bigger so you can see them more easily. If you have any technical difficulties, please click on the Help widget. It has a question mark icon and contains information covering common technical issues. If you have any other issues, feel free to chat us and we'll do our best to help you resolve them. Finally, because we always get asked, there is an on-demand version of this webinar that will be made available on ETF.com approximately one day after the webcast. You'll receive an email alerting you that the slides are ready, and then you can replay this entire session at your leisure. That email will include information on how to qualify for CE credits. That ends the housekeeping notes. With that, I'd like to turn it over to Brian and Douglas to run us through everything we ever wanted to know about factor-based investing. Guys, over to you.
Thanks, Matt. Hopefully we can live up to that. So by way of introduction, my name is Brian Wimmer. As Matt mentioned, I'm also here with my colleague, Doug Grimm. I'm going to be walking through the first half of the presentation, and Doug will be taking the second half. We're going to be talking about factor-based investing. As part of Vanguard's investment strategy group, we're tasked with researching, evaluating, and discussing a range of investment topics, and this one's been very popular, and for a lot of good reasons. You can see in the data the amount of popularity and growth of this category, the smart beta category or factor-based investing category broadly has had over the last 10 years. If we look back 10 years ago, there were less than 10 ETFs available that covered smart beta strategies or factor investing broadly. Today there are over 150. On an AUM basis, 10 years ago, during that same time period, we went from close to zero to over $220 billion in assets under management. So it's a popular topic. It's something that we get a lot of questions about, and we're here today to share more about Vanguard's view of this category, this topic, and give you a general framework for how we think about factor-based investing broadly, and hopefully how potentially that can help you think about the topic as well. So overall, throughout the presentation, we're going to discuss a number of topics related to factor-based investing and smart beta. But the three things that we're ultimately going to conclude is really that factors are the foundation of smart beta strategies, and we'll demonstrate that in a few slides. We'll also talk about factors or any alternatively weighted smart beta strategy being active management. With any active strategy, There's the potential benefits of those, but there's also potential challenges that investors need to understand. So we'll talk about why we view factor-based investing and smart beta as active management and what goes along with that. And then as active management, it's important to understand that if we're going to improve our odds of success investing or considering investing in these types of areas, we need to think about three primary things. First one is conviction. What type of conviction level do we have in a specific factor or set of factors? Consider low costs. Are we able to access different types of strategies that align with our conviction at a low cost? And then can we be disciplined about it? Can we invest in a way, given that again that this is active management, can we be disciplined and long-term focused to give ourselves the best chance of success? So we'll discuss a few of those things as we walk through today. So moving to the agenda slide, it might be taking a minute to load there. I'm not sure if we can see it on the live view. There it comes. So the agenda, we'll talk about the first two, as I mentioned. I'll take the first half. What are factors and the relationship between smart beta and factors? This will be more of the theoretical, big picture, framework type of look at the topic. And then I'll transition over to Doug, who will talk more about some of the practical applications, the key considerations and benefits, the applications and decision points that are important for investors in practice. So what are factors? If we're defining factor-based investing broadly, we're thinking about factors as really the DNA of an investment portfolio. Factors are what's going to determine how a portfolio acts and behaves, its risk and return characteristics. And it's really, again, that underlying exposure that's going to explain the returns of a portfolio. Within factor-based investing, we can think about many different factors. Some are compensated and some are uncompensated. And this is a hotly debated topic where factors, in theory, are supposed to be associated with a positive return premium, and some are not. So we can think about, again, the goal of factor investing would ultimately be getting exposure to compensated factors. And then if we're thinking about, again, the high-level view of factor-based investing in a framework, if we're going to be talking and thinking about factor-based investing, it's something we would need to consider in a portfolio construction context, thinking about how the exposures impact our overall portfolio, identifying and allocating to factors in a way that makes sense for our specific portfolio, and then to help us achieve, specific risk and return objectives using different types of factors. So as I mentioned before in the intro, we view factor-based investing and smart beta strategies as active management. And the reason why we start off with that foundation, it helps us really think through this type of investment process, is because market cap weighted indexes are the only neutral, macro consistent view of the markets. If we think about the zero-sum game and we think about market clearing prices, the market cap weighted index is really the foundation and the starting point. So anything that differs from that is going to be an exposure or an allocation that's going to be different from market cap weighted exposure. So we're taking on different risk and return characteristics from the market. Now that's not necessarily a bad thing. That's not necessarily a good thing. It's just different. And so it's something that we need to understand, and if we're thinking about it as investors, we need to enter these decisions with our eyes wide open with as much information as possible to help us evaluate whether or not strategies such as factor-based investing or smart beta specifically might make sense for us. So before getting into some of the practical applications, which Doug will cover, I want to dig a little bit into some of the academic research and the history of this topic as we follow it kind of through the years. If we look back decades ago, something all of us learned in finance or CFA curriculum, somewhere along the line, the capital asset pricing model. And that was really the foundation of the academic research in this category. And it started with a single factor, right, the market factor. Capital asset pricing model talks about the market being the driver of investment returns, just the general premium of your broad market exposure. But since then, there's been more discussion and more research into further factors, going from a single factor view to potentially a multi-factor one. So we have the arbitrage pricing theory, different anomalies that people started to research, And during this time period, along with this research, coincided the growth of greater powers of computing, better data, more history, things that could continue to be added into the fold of the academic research, which then ultimately turned into research on things such as the three-factor model from Fam and French, with the market, value, and small cap factor. And then Carhart adding in the fourth factor, momentum. So the four-factor model, now we have five-factor model, and even beyond that, we have the number 300 down there. If you look through the academic research, there's been approximately 300 different factors that academics have identified as either having some potential ability to explain returns or something somewhere along the lines where people are taking historical data and looking into it. So obviously the evolution continues as well as the debate because I think across all of these different factors that are identified both in the equity side, which is more of what we're talking about here, but also on the bond side, there's been debate and discussion. There will continue to be about these factors and exactly what they mean for portfolios and what they mean for investors. On the next slide, we have some of the commonly discussed factors. So these aren't necessarily the most important or the most successful. They're really just the most commonly discussed. We have market, value, size, momentum, low volatility, being on the equity side, plus on the fixed income side, having term and credit. So if you look at down this list of factors, again, not on a complete exhaustive list of the 300 that have been analyzed at some point in time, but we can see that when we get questions when we talk about this topic with clients, or when we see the product lineups of various firms, we look across the industry and see the alignment of different products, most of them tend to fall across these factors. So while this again isn't an exhaustive list, I think this can help us set the baseline for the discussion of different factors. And so up to this point, I've kind of been using the term smart beta investing and factor-based investing a little bit interchangeably. But so I want to be a little bit more specific about how we talk about factor-based investing versus smart beta strategies. And the way we view factor-based investing is that, again, those factors are the foundations and the key building blocks of a portfolio. They're the things that are going to explain your returns in other funds. We can think about that in the context of smart beta strategies. So if we're looking at smart beta strategies, we can see the underlying factor exposures within those smart beta strategies that essentially make up the smart beta or alternatively weighted indexing categories. And so that's where we find this link or relationship between smart beta. Factors is really the broader umbrella under which smart beta products fall. And so to talk a little bit more about that, we produced the next slide, an analysis using regression analysis using the Fama-French three-factor model. So that's a fancy way of saying what we try to do is look at some different common smart beta or alternatively weighted strategies and use the Fama-French three-factor model to essentially adjust for those factors and to account for the exposures within the smart beta strategies. And so what we're left with here on this slide, as you can see the bars, we either have an overweight to certain factors or an underweight to certain factors. If we look at a strategy such as the equal weighted strategy, which is the second one in, and we look over the course of the last 15 years, the weighting process in an equal weighted strategy is simple, right? You take the stocks, let's say it's the S&P 500, and you give them equal weighting. Well, what that does, if you think through the mechanics of a strategy like that, is it increases your exposure to small cap stocks because you're decreasing your exposure to large caps. And it also changes your exposure to be more on the value side rather than the growth side. And so we can see that here, is that when we deconstruct that equal weighted strategy, we can see that we're left with exposures that have similar market exposure to the broad market, but a noticeably higher small cap factor exposure and value factor exposure. So that's what we mean when we say that factors are really the underlying or the foundation of these smart beta strategies. And to substantiate that even further and talk more about some of the work that we've done in that, on the next slide, what I'm going to show is the different measures of essentially alpha and the statistical ability of that alpha to be predicted by the factors. So what we're doing here on this next slide is taking the t-stats from a regression for the existence of alpha. So we're using, again, that Fama-French three-factor model, and we're saying that I'm going to look at the excess returns above and below a benchmark, and we're going to adjust on a 36-month rolling basis. I'm going to adjust for the exposures to the market, to value, and to small cap stocks. And what's left over, I'm going to be considering alpha. Because if there's alpha left over, what that's telling me is that there's something other than those factor exposures that are going into this strategy, and there's something else there. But if the majority of that exposure can be explained by the Fama-French three-factor model, value, small cap, market, then we're saying that, again, it substantiates this view that factors are the underlying exposures, as the underlying foundations of these strategies. And so when we look at these t-stats, what we would expect to see if the alpha was coming from somewhere besides the common factors is that we would see these t-stats going above or below those gray lines, indicating significant alpha that isn't accounted for in the Fama-French three-factor model. But what we see across this full time period of almost 20 years is that those t-stats generally stay within the lines that we would consider insignificant. So we're looking at 0.05 significance, which is the dotted lines, 0.01 significance, which is the solid gray lines. And so again, when we're left over with the alpha after adjusting for factor exposure, we're not seeing statistically significant alpha either way. So it's saying that, yes, truly what we think is that the factor exposures are accounting for these smart beta strategies. So that's a look, again, at the high level, the theoretical implications, some of the things that we ground ourselves on in terms of how we think about factor-based investing. But the next step is to translate that into more practical considerations and getting into more specifics. So I'll pass it over to Doug to start talking about some of the key considerations and benefits of factor-based investing.
Thanks, Brian. In theory, of course, is an important aspect as any of us are thinking about making decisions in the world of investing. Many of you out there are likely practitioners in this space, right? And one of the most obvious questions that you probably are thinking is, well, how do I actually apply these concepts, to the real world? And so what I'm going to do is, through the rest of this presentation, is kind of talk to you about, okay, it's Brian and I do a lot of research, but we also try to meet with clients. We also meet with reps throughout Vanguard who meet with clients. How can we help practitioners out there make more informed decisions as they're thinking about factor-based investing and whether to consider it for a portfolio or whether to not consider it? And so that's what we'll walk through today. And so what you see in these three boxes, and I'll just speak to these at a high level because we'll get more into these as we move through, is really implementation aspects of it. So for instance, capacity. How much money can a particular strategy handle? So in the academic world, when you're putting together analysis, there's no constraint necessarily for what capacity a strategy can take. Liquidity and transaction costs, really those frictions. So if we're applying some sort of small cap methodology and we have to have real world transaction costs on a good chunk of money, what are the actual frictions and how is that going to haircut what those actual results are? Other ones are like factor definitions, right? So a lot of debate goes on both in academia and the practitioner world about how you actually physically define them. So for instance, value. Some may define it as price to book, some PE, some a composite of a bunch of different variables. There's a lot of nuances that go into it that can influence what you're doing, and we'll talk a little bit more about that as we go on how that could influence outcomes. The middle bucket there, explaining and selecting factors, continues on the point that Brian made earlier about this ongoing debate about what these factors are, right? So there's the discussion on what factors actually exist and are not just sort of data mining and fragments of the data, but are actually something that have some sort of economic rationale where, yes, this should explain returns and there's a good reason why. Diversification, so if you have a single factor and multi-factor, there's always the discussions around that. And then cyclicality on the right side is inevitably past is not prologue. We all know that from all the other things that we do within the world of finance, that past is not prologue in the investment world. Nothing works every year. The same thing applies in the factor-based investment world. And you got to be really patient, and we'll talk more about that in a little bit. But As you walk through it, for those that are considering factor-based investing, there's a bunch of different options, so we'll highlight 3 of those on the next slide. So the next slide is kind of the harvesting methodology. So there's really 3 primary ways that you can do it, and I'll speak quickly on the left 2 because those many of you are probably already familiar with, right? So style investing is something that's been around a long time, really gained traction in the 1980s with, say, like the style market cap indices, large, mid, small, growth value. You saw more of an evolution in that in the 90s with style box investing. And so those are getting you exposures with low turnover, but within those markets generally, if you're doing an index approach, you're usually doing it market cap weighted. So you're taking the value side of the ledger, and then you're market cap weighting the value side. With traditional quant, the center category, that's where you're usually using an active manager, and they're building a multi-factor exposure. It could be dynamic, it could be fairly static. Turnover varies. Some may be very high turnover, some low, and they may have factor timing. So they may try to be move the factors around over time, and may actually use different ways to define factors depending on which sector it is or which category that they're playing in. The third one, really the focus here, is the factor-based investing one, which is what we've seen more of more recently, and this can be done in an active or an index approach. Instead of market cap weighting the areas, that's more based on the factor weighting. So instead of saying we'll take the value category and we'll market cap weight within the value category, this is saying, hey, we'll rank everything based on whatever that fundamental metric is, and that's how the weighting will be. So it's typically more concentrated on the actual factor exposure that's trying to be exploited. It could be single or it could be multi, and as a result of that, the turnover can vary. You could have some that are a little bit lower volatility, some like momentum, which the turnover could be quite high as those move around. And it can also be employed in a long only or a long short way, and that can make a big difference, as we can talk about on this next slide here. So as you're implementing them, there's lots of differences. So what we did here is we just took a look at a couple of them, just a very small sample of global factors, and said, okay, what's the correlation with each of these global factors and the equity market factor, which all of us are very familiar with. And so obviously the market's going to have a one correlation with itself, but what you notice is the long-only factors across the page have a really high correlation to the market. So in other words, the co-movement, or do they move in lockstep or in a very different way from the market? And you can see, all the long-only bars are above 0.8, which is pretty high. So essentially what that's saying is when you're doing, say, like a long-only value type strategy, you're getting a lot of the market factor along with the value factor. So there's a combination of those. And as a result, you're going to have more correlation with the market, which is not necessarily bad, but it's just something that has to be taken into account when you're looking at implementation options. The other one is the long-short method, and the long-short method essentially constructs the allocation within that category to remove the market factor entirely. So you're trying to isolate that specific factor, and as a result, as you can tell from the bars, they're much lower. Momentum either being over this short period of time being negative, but this will be very time-bearing. Don't get too caught up in some of the correlation numbers. We use this on a global nature, but you can pick out different time periods, and those correlations will move around. But just suffice it to say is, it's very different if you're doing it through a long-only approach versus if you're doing it in a long-short approach. Along that lines of that implementation is, all right, these will not always be in favor, right? There's going to be good and bad periods that these are going to move through. And if we look at the next slide, you'll see some of the cyclical nature of this illustrated in what some in the industry call quilt charts. And so all we're doing here is each box represents the long-only return of a sample of global factors. And the boxes from top to bottom are ranked from best return to worst return in each calendar year. All right. So, for instance, in 2005, the best factor of this small sample that we picked from, momentum was the best, and the term factor was the worst. But the color pattern that you take away from this slide is, well, that there is no color pattern, right? So what you don't see is any persistence, whether it be high returns or low relative returns for any of these factors. They tend to move around quite a bit. In addition, and it may be hard to read depending on what computer you're looking at it on, but suffice it to say that the difference in return from top to bottom is really different across these factors over these different periods of time. So depending on which factor the investor is moving to or using or which combination is going to make a big difference year in and year out on what those are. In addition to the year-over-year volatility, there's also the question of the long-term patience. And to showcase that, the next slide, just in order to make this chart not too busy, we isolated it to 3 factors. And so what we did here is just a simple analysis. They said, hey, let's look at the 3 factors, value, size, and momentum, and said, what were their 3-year cumulative returns in a long short of just trying to isolate that factor. And so what you find here is, if you notice, I'll just to pick one just as an example, the dark blue line, the long short value factor, you can see from basically around 2008 to around 2014 had a negative cumulative 3-year return as a factor by itself. That could be hard, as you all know, for clients to stomach. It's hard for us to stomach as practitioners or theorists or whatever. It's even harder for clients who are not used to the investment world and are entrusting advisors to manage wealth on their behalf to have returns that may be out of favor for significant periods of time. So let's say that they pair this with the momentum factor. Well, if you look at the lighter blue line, the momentum factor, you can see that from 2009 to about 2012, that factor by itself had also had negative performance over the time period. And so if you pair them even together, the 3-year return was still negative. So just the clear point or the clear takeaway from this is that the period of time with which some of these factors could be underperforming could be potentially long. And there's no way in advance to know how long that will be and to what extent it will be negative. In other words, will it be 3% negative, 10% negative, 30% negative? I mean, you can go back in time and kind of look at it retrospectively, but as more of these factors are understood and potentially implemented, it's really hard to say what the cyclicality will change going forward. There's certainly some other considerations to it, but what are some of the underlying benefits of factor-based investing for those that are considering these types of approaches? So if you look at slide 16, the left-hand side, transparency is a big one. For strict factor-based investing, if you're doing it through factor-type funds, there's explicit, clear exposure. You know what you're getting. It's not as clear through smart beta-type products, which may have indirect exposure to factors, as Brian was pointing out. And with some smart beta products, that factor exposure is going to vary through time because they're not targeting a specific factor. It's a byproduct of the process through the weighting mechanism. And so that transparency of that is pretty critical. And as a result of that transparency, it makes it easier in that center column for control. And this is going to vary by practitioner. So, right, so you're going to have some that we're going to like more control where they can calibrate or customize that exposure. There's going to be others who want to delegate it, right? They're going to want to delegate it to a professional manager through a quant equity product or something of that nature, who can implement a time-varying exposure to it or some sort of static approach in a multi-factor way. So there's a lot of different vehicles that can do that, but try to do that. But control is a clear benefit of these types of ones for people that are thinking about implementing a factor-based approach. And the last piece is cost on the right-hand side. And the cost will certainly depend on what you chose in the control factor. So it's going to depend on which factors you thought of and also in what way you want them. If you want a more dynamic, active approach, that's probably going to cost a little more because the implementation is going to be through an active manager. If you want more of a static factor tilt, that's going to be really cheap to do. So how should you frame the investment decision? And this is really key. And this is something that we spend a lot of time talking to clients about and talking about internally is how do you really apply this in a decision-making criteria? And so on slide 18 here, this is how we kind of frame it. So market cap weights to us, to Vanguard, is really the starting point, the neutral starting point for investing. It's the weighting scheme that everyone can own. It's macro consistent. We believe it's the best proxy for asset class exposure, consensus view of all participants. It's going to be low turnover, low cost, very high capacity. That's the starting point. if you pivot from that, then you're moving into the active world, and you should treat anything of that nature as just another active decision, whether you're buying a bottom-up active traditional fundamental manager or whether you're looking at factor-based investing. And so as we treat that as an active decision, there's a decision-making framework that you need to go through. You got to decide, how do I want to achieve these factors exposure? Do I believe in just one? Do I believe in multiples? What kind of combination do I believe in? Do I believe that it should be static or dynamic? And you have to have this selection criteria, just like we've said, and we published in our prior work on when you're acting in active management in other realms, is you got to have conviction in what you're employing. You want to get it at a reasonable cost, and you got to be disciplined about it, because depending on what your active risk budget is. The difference in particular with factor-based exposure is that unlike traditional active, the decision is, well, you're not deciding whether to terminate a manager or rehire a manager. You're deciding, in theory, what you believe your conviction is in those factors. And so let's say down the road, say 3 years from now, you've decided that that's a relevant period with which to evaluate yourself, or that's a period with which your clients have decided that's when they want to evaluate you. Then you get to decide, all right, if I'm underperforming, what is my process with which to decide whether I pull the plug on this? Do I still have the same conviction I had before? If you do, you should rebalance to it, right? You should take it up to market weight, or take it up to the weight with which you have as a policy allocation, because you should still have that same conviction. You may even have stronger conviction, because you may say, hey, I'm a contrarian. I believe this is out of favor. Let's put more weight to it. So that's going to make that decision-making process in a different way. And in part, that's going to depend, going back to what we talked about earlier, is that control aspect. So the control aspect is, do you want, as your firm, as your financial advisory firm, to control those? Do you, as a personal investor, want to control those factor decisions or those tilts? Or do you want to have that delegated to some professional manager or advisor, or do you want that done in-house? So that's going to have a decision-making process there. You're also going to want to have to decide what kind of decision, risk management process you want to have. So let's say that you have a bunch of different funds in your lineup, and some of those are not factor funds. Say those are traditional fundamental funds. Well, you can decompose their returns too, potentially, into factor exposures. So you may want to look at it across the entire portfolio to say, hey, across everything, what kind of exposures do I have? And are those the ones that I want? And if some of the ones that are in there are not ones that I want, then are there vehicles out there that I can do to try to neutralize some of that? And what are the vehicles that are potentially out there that I can use to help, add to some of the factors that I do have strong conviction in? So that's just at a high level, kind of that decision-making process. But that is a really important takeaway for us, and we want everyone to make sure really resonates, is that if you're looking at factor-based investing as a potential option, as an active approach, you really want to apply a very similar mindset that what you do to any other active decision. So really, to wrap up, what are Brian and I really ultimately saying throughout this presentation? It's the three main things. So number one, we believe factors and factor-based investing is something that explicitly integrates factor exposure into the decision-making and portfolio construction process. All right, so that's really important. So the considerations for those is, the client's tolerance for active risk, knowing full well that there'll be cyclical nature to it. Whom do you want to extend that exposure? Do you want it to be indirectly through a smart beta product, or do you want it to be direct through a factor-based product or a quant product? And then the key success drivers. Since we do consider it to be an active decision, you got to have the conviction, and be able to either taking single factor or blending them. Low costs in the products that you're using to implement, and getting what you pay for, and then the discipline to maintain those positions and rebalance them over time. And with that, I will turn it back to Matt for the Q&A session.
Thanks so much, guys. Great presentation. I'd remind our audience, if you have a question, please use the Q&A tool at the bottom of the screen, and we'll get to as many as we can in the remaining 25 minutes that we have today. I guess my first question to you guys is about this concept of taking an active bet on specific factor exposures. Just generally speaking, are there reasons to believe that taking that taking an active approach to factors will be any more successful than taking an active approach to individual security selection. I'll just stop there.
Yeah, I would say, this is Doug. I would say, generally it's going to depend on the process with which the underlying investor is going through, right? So we don't necessarily fundamentally believe that it's any higher or lower probability. In part, it would depend on what factors we're talking about. But suffice it to say, for this discussion, we'll keep it to the short answer. Is the security selection aspect is one way of adding value through the stock selection process of individual securities. Matt, as you pointed out, there could be the definition of whether doing it through a quant approach. Vanguard has both types that we have here. We have, obviously, as everyone well knows, market cap indexing. We have fundamental active, and we have quantitative that we all do here. And we wouldn't say, and we don't do that with anybody that we advise, say necessarily that one is better than the other. It may come as a result of discussions with clients in making sure that they're comfortable with the types of approaches that you're thinking about employing, that they may feel a little bit better about which ones that we end up going with for them, or that maybe they decide they don't want to employ any of them at all and stick to a market cap weighted indexing approach. But the evolution is going to be interesting too, because factor-based investing is a little bit different in that the bottom-up stock selection process is just that, whereas factor-based investing, you could see trends, additional growth in those areas and cash flow moving those areas, which could change the prospective look on what to expect from those over both short and long horizons. And that we think is going to be an evolving process and something that we'll have to monitor. It's difficult to explicitly determine what that is and what metrics to look at to be able to see precisely what those opportunities are. But it's certainly an open discussion and debate.
Yeah, absolutely. I want to hammer in on that a little bit, because that certainly has been a topic of discussion. Just get more on that. Are there sort of capacity limits or an observation effect? There was certainly chatter when all the money flowed into low volatility strategies. If low volatility strategies became overpriced, I hear similar talk now on dividend-weighted strategies and potentially overvaluation in dividend stocks. Is that something to be concerned with? When factors come into vogue, do they lose their sort of historical mojo?
Well, I guess the way I tend to think about this is in the context of the overall market factor. So if we think about the market broadly, if you pile into any factor, and if for instance just the broad equity risk factor gets bid up because of kind of a significant run up in the markets, that's going to impact potentially the future prospects for that factor premia. So if a premia exists, crowding into that factor could potentially have a short-term benefit. It could impact things long-term on the negative side. But I'd say for us, it's really difficult to predict those things in advance, which is why when we think about it, and one of the things we noted in the presentation in a couple places is more around this disciplined idea is if you have the conviction, if you believe in a certain factor or a certain collection of factors, it's important to be disciplined and committed to that through time, just like any active or broad investment philosophy. Because that time-varying nature, if you're kind of moving in and out, from one ETF to the next, we think that's ultimately going to be a difficult game to win. So I'd say yes, all those factors are at play in terms of the potential for bidding up factor prices or capacity being limited, both in a positive and negative light. It's just I would point out just how difficult we think it is to predict, when and how that's occurring.
Right. We did just get a question about that. When you're talking about long-term buy and hold exposure to factors, I mean, you showed some very significant periods of underperformance. How long is long? How long must that conviction hold, both for you and then again for your client? Yeah, well, this is always the funny question when we talk to clients. I've talked to clients who consider long-term 6 months. I've talked to other clients who think long-term is 10, 20, 30 years. I think Doug and I probably land out on the latter side of that. To us,
3 years isn't long term. 5 years is even tough to define truly as long term. I think it's only when you get into the 10, 15, 20-year space that this is long term. It doesn't mean that you have to stick with an exact investment philosophy and stay with it that entire time period if your or your client's goals change or if needs change. But again, we think if you're going to commit to any type of active management, it should be on a long-term basis, which for us is 10 plus years.
Yeah, I'd say too,
Right.
just an important aspect of it is really the behavioral finance angle to it. And so one of the things that when we're having these index active discussions with clients is analyses like this and those of others that produced that shows some of the historical in and out of favor nature of these things. It's really important up front with these clients because to the extent that anybody is employing these, they have to know up front that the holding period needs to be material in nature and be able to stick to that. And even through good periods, and we'll tell this with clients who are using active funds, like, hey, this is not going to work every year. We're going to come to you and have a report that's going to have a negative sign on relative performance, and you need to be comfortable with that. And usually the more upfront legwork in terms of education that one does, it makes it a little bit easier on the back end, although it may not make them feel any better about the relative money differential. But but the other beauty of it is just the calibration exercise. So some of the analyses that we showed is really when you're isolating those factors by themselves. So part of the exercise can be when you're thinking through maybe what that active risk budget is for a client. It's just calibrating the exposure. So if it's a client that's more risk averse on an active basis, then maybe the vast majority of their portfolio is market cap weighted, and then they have a slight tilt to the factors that the advisor believes would work or whatnot, or to the extent that they believe in active approaches. That it would only be for those that have more of a risk of an appetite for that, with an advisor that has more conviction that certain factors would work, that they would they would turn the dial to having a much larger active approach, which would lead to active share and other sorts of things where there can be more dramatic underperformance and outperformance over time that people would have to be patient with.
Yeah, absolutely. How should investors think about how these factors interact? You mentioned there's 300 factors. Presumably, if you bought them all, you'd end up with the market portfolio. So how should people think about the correlations between factors and how to put together portfolios of these without them counteracting each other and just ending up back at square one?
Yeah, one of the important ways to start out is to say, where is your starting place? So if you're presuming that somebody's starting with a portfolio or model portfolio that they're using for clients today, the question is, are they redesigning the whole thing, or are they modifying it a little bit based on whatever their belief set is? So from that standpoint, what we would say is that the first thing that the firm would do is determine what at the end of the day that they believe they have conviction in, based on the research department going through their analyses and determining those that they feel like would work over the long term, and then saying, all right, if there's more than one, how do they look together, paired, or what is our relative confidence that one will add value over time versus our relative confidence for another? But you're right. Some are going to have high correlations with each other than others, and some there might be causal reasons for that. Others there might be spurious reasons that may occur over time, or some may work. But it comes back to that. So it's evaluating the current portfolio and saying, what are those exposures today, and modifying it to get the exposure they're looking for. But it's critical, we'd say, Matt. I mean, you really want to, if you really want to employ this type of approach, you have to take it from a quantitative lens to say, where are the exposures in the portfolio today, and what are we looking to get, and compare those and say, how are they, the different factors evolving over time relative to each other, and the relative confidence aspect to it.
And just to add on, we're thinking about kind of the combination of factors in a portfolio. We can look historically, take 10, 20-year averages of different factors. but Doug touched on this a little bit, is that the correlations tend to be dynamic. So they're not always moving in the same historical patterns that they have in the past. So you could take two factors which may have a low correlation or an uncorrelated, let's say, value and momentum, but you also see some periods, as you saw in one of our slides, where value and momentum were correlated for the most part and did experience negative returns versus the broad market from a factor perspective. So we try to build kind of a framework and construct for thinking about it on a simplified basis, but at the same time there's a lot of moving parts. Correlations don't stay the same through time, premiums don't stay the same through time, volatility changes. So that's what makes this a kind of a rich area for continued research, and also a one that you need to be kind of go into with your eyes wide open if you're considering this in a portfolio.
Yeah, I mean that was the next question. Imagine I'm not you guys. I'm not two CFAs with a research agenda. Vanguard have seen a slide from your firm before that showed that ETFs that come out in the factor or smart beta space, their back-tested data consistently crushes the market, and their real-world data is much more mixed. If I don't have a firm individual conviction about a specific factor, and I don't have a full research team, but I see all this great back-tested data and new products coming out, how do I realistically think about whether these make sense to add to my portfolio?
Well, to me, it's really the same as any form of active management. And what I mean by that is if I see the performance of a traditional active manager, a stock picker, and they're had tremendous success over the last 5 years, I can just simply invest with them in hopes that they're going to continue that success, or I can use greater resources, more time, more effort to try and be successful on a forward-looking basis, because history doesn't necessarily repeat itself. It may in some cases, but in a lot of cases it might not. So it does take time, it does take effort. So does any form of active management if you're going to give yourself the chance to be successful. So for us, the decision to move from a truly passive market cap weighted portfolio to any type of active management, whether it's factors, smart beta, quant, traditional active, alternatives, any of those categories, is a big step. And it's not always going to be the right step for every advisor or every client, but for those who can kind of wrap their their process and their philosophy around it, they have the resources needed, they can do the research and hopefully make an educated decision that they can have conviction with, because that's, again, going to be determining your success, whether you do have that discipline through time. But at the same time, that isn't always the case, right? Sometimes the resources and the time aren't necessarily there, and sometimes these active strategies may not beat a passive index anyway. So I think there's room for people to fall out on both sides of that. Some people will take the time and effort to research these, while others, I think, can have a very successful portfolio without active strategies.
Yeah, I'd say without, to the point with it, without the research team, you'd certainly, the first step to me would be you have to read up on evidence from a group of different organizations. Different people write about different things and may have different motives behind what they write, or different reasons with which they may want to write it. So, what an advisor would want to do, going out there, is to try to read up on different factors, but read about from the perspective of different either academics and practitioners potentially that have written up on it, and find firms in both camps. Find firms that believe in it, and see if you can find papers that don't believe in it, and try to go through that, because as quantitative as all this stuff can be, there has to be a qualitative overlay, just like regular active management. There's no single point solution, no silver bullet. No, that's at the end of the day what we all want. But we all have to, at the end of the day, really think through this, and make a really use our collective professional judgment at the different firms that all of you work for, and just decide, hey, what do we really believe after all of this evidence that we've collected from these various providers? Think about the real world application of this in the future and whether we think it'll be persistent over the long term.
Awesome thoughts. We have a bunch of sort of quick, smaller, more technical questions from the audience that I'd like to run through quickly. And I'll just ask them and answer them as quick as we can. First, can factor-based or smart beta investing be sufficiently tax efficient versus market cap weighted index investing to make sense in a taxable account?
For us, we would say over the course of kind of a full market cycle, market cap weighted indexing is absolutely going to be the most tax efficient way to invest. So it really comes down to your assumption of what type of return benefit or detraction you're going to get from that factor. So it's tough to tell in an individual situation, so can't give advice in specific scenarios, but absolutely the first place that we would think of for taxable accounts is market cap weighted indexes because of their tax efficiency. So to the extent that there's space in tax deferred accounts, that would be the preferred place for any type of active management as a starting point.
Yeah, and in part it depends what you're comparing it to. I mean, smart beta is a general concept, and there's a lot of flavors of ice cream of smart beta. There's going to be some that, if you look at the broad community of smart beta funds, there are some that have fairly low turnover, not market cap, but fairly low, and then others that just by nature of how they're designed, like Momentum or Equal Weight or something, are going to have higher trading costs or higher turnover, so they're going to need a little bit less tax efficient from that. But it's going to vary. There's certainly unequivocally a spectrum of tax efficiency across the smart beta world. Like dividends, for instance. Dividends, obviously if you have a high dividend yield fund, that's going to have more taxes just by nature of the higher dividend yield. So. Yep,
absolutely. So a tax-deferred preference if you can manage it, but it will be a spectrum. The next question is a simple and funny one. But why are size and style excluded from this whole factor-based strategy? Shouldn't a decision to invest in the S&P 500 and nothing else be considered a factor bet?
Well, I mean, if you look at the broad exposure, and the question is, what are you comparing it relative to? And so, if you look at Vanguard's starting point of looking at the whole market and starting with whatever all investors could potentially own at the same time, which would be market cap, that's the macro consistent one. If you start with that starting point, which is what we believe, then any modification from that would create a difference in factor exposure. S&P 500 as that example, would have, I believe, relative to, and I haven't looked at it lately, but I would assume has, a slight negative size tilt because it's going to be a little bit more on the large cap potentially, versus a total market index, which has the whole gamut of stocks, large, mid, small, all across the universe. Those factor tilts, something like S&P 500, those tilts are going to be minor relative to, say, the smart beta world. Does that help?
Yep. No, that's a great answer. That's a great answer. Another couple short questions from the audience. Are there any ESG factors that you found that are compensated in any statistically significant way?
There hasn't been any broadly talked about in the academic community evidence of ESG factors being compensated. I mean, it's certainly a growing area, especially in Europe, of an area where there's more of a view on at least looking in that area. But and there's varying natures of how widely accepted some of these factors are. But in relative terms to a lot of the other factors that are out there, there's nothing that stands out as one that has broad academic acceptance.
Mm-hmm. Speaking of overseas markets, are any of these factors, is their sort of significance and impact in the market and their visibility as you analyze them different from country to country to country, and if so, what would explain that? of the major factors?
Yes.
In
So,
other,
I mean, it's tough
in other words,
to go across.
yeah, go ahead.
I'm thinking trying to go across geographies and across different factors, and I'd say a lot of the primary factors that you've heard about most in the research, there tends to be substantiating academic research that goes beyond the U.S. and looks at other countries. But I think you're probably getting into, once you get outside of some of the most heavily researched, I don't know if we could definitively say that. So I'd say, yeah, for some of the most popular factors that people have seen evidence of that across geographic regions, but it's tough to make a blanket statement kind of one way or the other.
Yeah, I mean,
Right.
Some of the charts that we used here and in the paper we use based on global, but it's true that they don't move in lockstep, especially the market factor, right? You see international and U.S. equity move differently over time, and part of that is always going to result from currency exposure. So currency is always going to have an influence, assuming the investor is not currency hedged, but as different economies evolve through time and different markets evolve in different ways, where, for instance, Japan in the late 80s went through a really big rise and then a subsequent really bad time through the 90s. Whereas in the 90s, U.S. had a big run-up and then a big drop-off in 2000. That's going to lead to differences because the market participants in that game may be different, and there's different things, in terms of economic growth and different inflation factors and different fiscal regimes that are going on that could influence those markets in different ways, and as a result lead to time-varying nature and how those factors result in practice in those areas.
Great. And one last question, just on the specifics. In your charts, what was the look-back period you used in your momentum factor, and how harvestable is momentum as a factor strategy?
Let's get back to the momentum slide. Let's see here.
Do you know which slide you're referring to specifically? It's the
Slide 15.
I mean, we could take...
Because there's three slides. There's one with correlation. There's one with, and there's two with return. There's two different ones with return. I can speak to while Brian's turning to it just on the implementation ability. That's one of the ones that's been challenged the most in terms of investability, and maybe the most open to debate. I mean, typically, ranking schemes, and they'll vary depending on the provider, but momentum exposure can be something like what's done the best over the year versus what's done the worst over the last year, and creating deciles for that. But there's typically with momentum a lot of turnover with that, and I'd say there's still ongoing debate there. I don't think we necessarily resolved it ourselves on that note, but the turnover rates are incredibly high. And typically, it's very difficult to implement in the small cap arena. If you're employing it, tends to be those implementing it more, at least in either in the mid cap space, the large cap space, and trying to do it with potentially more liquid securities because of the high turnover.
Probably a good thing to just
Awesome.
highlight too, the broad implementability of kind of all these. When we think about it's maybe something good to leave listeners with around kind of the academic research versus what we see in practice, is that, in practice these are more challenging. We're dealing with, trying to actually incorporate trading costs, incorporating turnover. Can we actually access the stocks and have the liquidity that the academic research uses in practice? So if people are reading the academic research, they also need to understand that while the academic research is helpful and a good starting point, that doesn't always lead to success, or that doesn't lead to any type of guarantees in practice, because that can certainly be different.
Absolutely. I think that's something we should all keep an eye on. Well, guys, I want to really thank you for taking the time today to deliver this message to us. This was, it's not always true that you get sort of smart beta without the hype, and this was a real good hard look at the reality of factor-based investing. So thanks. Doug and Brian, for taking the time. Thanks also to the audience for joining us today. I hope you enjoyed this. As a reminder, a replay of this presentation will be made available within about a day. You'll receive an email alerting you that that's available, as well as information on how to qualify for your CE credits. We do have a webinar each day this week on the theme of smart beta and factor investing. Tomorrow's webinar at 11 a.m. Pacific, 2 p.m. Eastern, is blending smart beta into a portfolio, 3 easy steps. So I'd encourage you to log on and listen to that as well. I hope you all enjoyed today's session. Thank you for spending an hour with ETF.com and with Vanguard. Have a great rest of your day, and see you all tomorrow.